Welcome to this session. This is the breakout session A, it's called. And it has, as always, in INET, a dramatic title: The Eurozone Currency System, Catalyst or Wrecking Ball of the European Union. We have an excellent panel here with us. Three of them, three first speakers, Erik, Berglöf, Lars, Feld, and were members and signatories of the INET Council Group on the Eurozone Crisis, which published a report last July. And the two commentators were observers in that process, also took part in some of the discussions, James and Leif Pagrotsky. I will not introduce them with biographies because you have them in your papers. But let me do an exception for Leif Pagrotsky, since his photo, for technical reasons, was not included in the papers. Leif was is an economist with a distinguished career in Sweden and in international organizations, including the OECD. He was advisor to the Swedish Prime Minister and to the Swedish Finance Minister. He was himself a member of government for 10 years between 1996 and 2006 in Sweden. Sweden, of course, is not a Euro area country, and I think Sweden is not a Eurozone country, and I think Leif Pagrotsky approves of that also now. But in any case, he has a direct experience as a politician of how the European Union works, since he attended a great number of meetings in the European Council. So let me start. When I got this assignment, I thought we would stick to some of the ideas in the INET Council report of last June or July, because I think it was an admirable report. It was, for my taste, a little bit too pessimistic at the time it appeared. It had a similarly dramatic tone as the title of the session. The first sentence of the main report is simply as of July 2012, Europe is sleepwalking towards a disaster of incalculable proportions. And they go on to argue why that is the case. I don't know whether that's a fair description. I think the title of the session is in a way better, because Europe is not really asleep. There have been too many rude awakenings for that, also since July of last year. But I want to propose three topics, as I did in a background note that you will also find on the homepage of INET. First, is the assessment still as critical as it was at that time? What is the balance between positive developments and negative developments since last summer? Secondly, what is the current status of the main idea, as I saw it, contribution of that report, namely that it's useful, maybe necessary, to distinguish between what is required to get out of the current crisis and what is desirable as a long-term structural reform of the European Union. I think it is helpful to make this distinction, as the report did. And finally, maybe to discuss a bit more specifically a couple of the initiatives that have come up since last summer, the banking union in particular, but also the changing role of the ECB. Let me be extremely brief on these 3 points. I know that the panelists have made their own preparations and will want to add to that. And we have with the two commentators, a historian who will bring the perspective and the unfortunate analogies to the interwar period and the tensions, the political tensions in Europe at that time. We have a former policymaker, Leif Pagrotsky, who will bring the political experience into it. But let me comment briefly on these 3 points. On the positive side, since last summer, there has been progress in some of the countries that are in programs. They're not exactly success stories, but they are recovering. I'm thinking particularly of Ireland, but also of Portugal. Greece has a government which was uncertain at the time last summer when this report was prepared, one that is prepared to do some business with the European Union. The agenda of the European Council and the European Parliament to finish the surveillance mechanisms that were developed from 2010 on has been completed this spring. Above all, of course, the ECB made the notable declaration last July through President Draghi that the ECB was ready to purchase securities in unlimited quantities, provided, of course, that the country in question had already requested a loan from the European Stability Mechanism. The European Stability Mechanism itself was not operational last year, but it has become so subsequently. So there are some positive developments but there are also very negative ones, of course. The economic forecast in particular are still being revised in a downward direction for 2013. Unemployment has risen to totally unacceptable levels in several countries. And we've had recently the experience of Cyprus, which provided very divisive again, and the perceptions from that have clearly been negative. So one question to the panelists is clearly, how do you assess the balance of positive and negative developments as they are now? Secondly, what about the main idea that the report developed last summer, the idea of distinguishing between crisis management issues and structural improvements? The distinction also made, I think, yesterday in the evening discussion by Bill White in commenting on Lord Turner. The European Council has made progress, or Euro area has made progress in both areas, particularly on the long-term revisions. Better mechanisms of surveillance have been put in place. They should, of course, have been there all the time, and they might have been if the problems had been anticipated to the extent that we now know them. They have gone as far as they probably can within the limits of the current treaty framework. But the exit from the crisis has also advanced, but is clearly lagging behind. The report last year made the basic point that the legacy problems of bad banks and sovereign debt are critical and will require more solidarity and generosity than the long-term reforms that are, in a way, being carried out. What are the best options then for moving ahead in this area? What is the nature of the extraordinary ad hoc efforts that have to be made? And would the message that certain efforts are to be done on a temporary basis without setting in motion the whole framework of treaty revision on a more permanent basis, with all the risks that would entail from disaffected electorates and the interaction between negative electoral responses and impatient financial markets? Is there a way of separating out some of these problems and solving some of them on a temporary basis, or does one have to go to the full range of revisions or permanent revisions? Finally, on the banking union and the role of the ECB, banking union has come onto the picture of the realistic revisions by, in a sense, a historical accident. There was a passage in the treaty that allowed supervision to be collectively exercised in the European Central Bank. But going beyond that to setting up a common resolution mechanism is more difficult, and more demanding still would be the long-term problem of a common deposit insurance. I think this case illustrates quite well the point I made about distinguishing crisis measures from long-term measures. And the case of Cyprus is an illustration in point. The idea last summer when the European Council pronounced itself on banking union was that it would be a crisis resolution mechanism also, that the European Stability Mechanism would finance, help to recapitalize banks at an early stage. Now the time scale has slipped somewhat. We are going to be 2014 before we have the common supervisor in the ECB, and there's a problem of then using that mechanism and not contributing to recapitalization for problems that antedate that common supervisory mechanism. And the case of Cyprus, of course, illustrates that the more permanent mechanism, if that is what you aim for, could involve more substantial elements of bail-in, of creditors of banks, not only the of course shareholders, but the creditors of banks, junior and senior, and even the large depositors, and that has created a lot of uncertainty about the nature of it. But if you wanted to do a long-term revision only, that would be the route you would take, I suggest, and that may be what the Dutch chairman of the Eurogroup said in his much criticized statement. He doesn't recognize it as a crisis resolution mechanism, but then you have to resolve the crisis in some other way. Finally, on the European Central Bank, at Maastricht, European Central Bank was protected in several ways against being distracted from its monetary mandate. It was protected by not being allowed to finance government deficits, public institutions. It was made very complex for it to conduct foreign exchange operations, and it was not supposed to have any role in supervising financial stability. Now that last point has already broken down. The ECB now has responsibility both in the area of macroprudential supervision, of structural issues, of systemic issues, and from 2014, supervising individual institutions, something that was assisted at Maastricht. But the two other elements are still very much in the balance, and the question is whether the original vision of Maastricht with a strongly independent central bank with a clearly monetary mandate but no general macroeconomic mandate will stand up. And I welcome comments from the panelists on these topics as well. So let me immediately go to the first of the panelists, Erik Berglöf, Chief Economist of the European Bank for Reconstruction and Development in London.
So first of all, I want to thank the organizers that they invited us. They allowed us to escape, if only for a fleeting moment, from the Eurozone crisis and all that it brings in terms of disruptions. And it's been going on for a while, so we needed this break. The problem is that in Hong Kong, it doesn't offer full refuge from the Eurozone crisis. There is, every time I come to China, there is this bombardment of questions about what's going on, and it's very hard for people to make sense of what's going on in Europe. I only have one consolation. It's also very difficult for us, the Europeans, to make sense of it. Imagine for a moment that, let me nevertheless make an attempt to make sense of what's going on. And I thought what we would try to do is to see, are we closer now or further away from a solution than what we were when we last met in Berlin a year ago. In order for that to make that assessment, you need to have some kind of reference to what is, what are we aiming towards. And I thought I would use this report that the panel members here were signatories to, and that Niels Thygesen referred to in the beginning. Niels quoted the introduction to that report. It's hard maybe to put yourself back into the times that we had then. It was a very dramatic time, a time that when certainly many of us, I think all of us actually, who met in June last year, had this sense of urgency that it was the Eurozone was hanging in the balance, and there was an impassionate manifesto signed by George Soros, where he claimed not only was the Eurozone hanging in the balance, but ultimately also the European Union. And so, yes, the language in the report was dramatic, but it was a very dramatic time. Let me just for a moment imagine that that indeed the Eurozone did collapse, and that we created a museum for over the Eurozone, and perhaps George Soros would contribute to this museum. It was going to be a tribute to the sort of valiant, but in the end futile efforts to create a deeper integration at the European level. And of course, naturally, the entrance fee would be charged in D-marks. So what I was trying to do is to take you through this museum and take you through the various exhibits that you would have. So imagine walking through this museum, and the first rooms would somehow depict the many successes of the 10 first years of the Eurozone. And then it would come to this special wing that was dedicated to the crisis starting in 2008 and onwards. And after several rooms, you sort of exhausted, come to this room that deals with the situation we were with in last summer. The first question is, of course, to ask what were the objectives that we saw at this point last summer. Well, clearly the main objective, short-term objective, was to restore faith in the Eurozone. The second objective was to reverse the growth in unemployment and the output declines, and to reduce debt levels in the medium term, and to address structural flaws in the Eurozone design. So, what were the Eurozone design flaws? Well, basically there are three aspects that I want to focus on. It's an arrangement that's tying your hands, but it didn't really pay much attention to the ex-ante incentives. They were very weak, and the fact that you had EU-level monetary policy and national level fiscal policy and banking supervision, that led to overborrowing and overlending both in the private and in the public sector. There was also an ex-post disciplining problem, in the sense that it was really excessive. So there was no crisis resolution mechanism, and as a result, this commitment device destroyed value, and of course, to some extent, that reduced the value of this mechanism ex ante, the credibility value. Finally, there was no mechanism, as we know, for resolving banking crisis, and instead you created this diabolic loop between the sovereigns and banks. And in that room where you described, you will probably see this exhibit that we very much lived in, and actually to some extent still live in, where you see a deterioration of sovereign balance sheets, and that is affecting banks' balance sheets, and in turn further deteriorating sovereign balance sheets. So it was about breaking out of this diabolic loop. So what was the program? Yeah, first of all, as Niels Thygesen said, the program was about trying to deal with the situation at hand as it looked last summer. It tried to do something which was sort of finding a politically feasible solution. It had a group of 17 economists from both creditor and debtor countries and from across the political spectrum. So the idea was to try to create something that would be politically feasible, and see how far can you get if you impose these political constraints on the solution. And what was very key, and Niels Thygesen emphasized this in his introduction, was to separate the legacy problem, the accumulated debt levels, both in the private and the public sector, and the steady state. So what type of arrangement would you like to have in the long term? And there was an agreement that has to be some sharing of debt, of the legacy debt. That we all, all the signatories to the Maastricht Treaty had some responsibility for what had happened. It doesn't mean that it had to be shared equally, because there were also, of course, measures in some debtor countries that they needed to take responsibility for. But there was a fundamental sense that this is a burden that should be shared in some way. We also proposed, and remember this was before the decisions of end of June last year, we proposed the idea of a banking union with supervision, with resolution, and with deposit insurance. And we thought that actually all this could be achieved with a very limited fiscal union. So really the fiscal union would be the fiscal union that was needed to support the fiscal backstop involved in the banking union. And I think that was something, of course, where there are many different ideas in the group of economists, what would be the optimal level of fiscal union. But in the end, we could all agree that some element of fiscal union would be necessary, and many of us thought that maybe it could operate quite well with this quite limited fiscal union. And of course, very importantly, and at the time, but still, is to use all available means to stimulate growth. So, of course, at the time in this museum, you will also see these attempts to make fun of the even in the very austere times, to try to make fun of what was happening. So let me spend a few more minutes on the proposal. So in the short term, there would be this mutualization of legacy debt. There would be a recapitalization of the banking system. There would be a financing of debt beyond 60% of GDP, provided that a country adheres to adjustments in the medium term. This is very much the proposal by the German Council that we thought was a very attractive solution to deal with the legacy problem. There would need to be a growth package to help debtor countries. The monetary policy should accommodate, and surplus countries would need to use any available fiscal space. And but very importantly, the mutualization would be finite in time, and its costs would be limited. So again, this is about the short term. And there are a few other measures that we saw absolutely a critical role for the ECB in the crisis, to ensure the monetary policy transmission and to support countries and provide liquidity. It was about fiscal structural reform. It was about fiscal evaluations. I won't say more about that now. The long term was very much centered around the banking union. We thought that the banking union could really address, if it was implemented in full, could really address these fundamental design flaws of the Eurozone. It was about common financial supervision. It was about a debt restructuring mechanism and resolution, and it was about the common deposit insurance. We also discussed the fiscal rules, and we discussed the mutualization, and here we had again this very narrow notion of what was needed in terms of mutualization. And one thing that was quite important we felt about the banking union was that this, for the first time in a long time, there was a sense that this is a project that actually there could be some democratic legitimacy, given what's happened in the crisis and what had happened inside the banking system. An approach where we provided a framework where there was a sense of rules, and it made sense to deal with this at the EU level, not at the national level. And given the weak legitimacy democratically of many of the things going on at the EU level, we thought this was a very important aspect of the banking union. So where are we? Let me just very quickly take stock of where we are. I'm going to look at three aspects. It's about first ECB. Well, in the end, ECB played, of course, a very important role. It played a slightly different role than we had suggested, but it did play a very important role. It did provide liquidity to the banking sector, and is still doing so, and it's absolutely critical, particularly for the countries that are most exposed. It did introduce this new program to support, or actually to lower interest rates for the debtor countries. There are many aspects of this program that are still very unclear. It hasn't been really tested. For example, the element of conditionality, what does it really mean? How would it be implemented, and so on. And of course, what was also critical was this drug is whatever it takes, and that has helped so far to get us through. The second aspect is the banking union, and here clearly this has gone in some aspects very fast. In other aspects, of course, we are still very far from a complete banking union. This creation of this single supervisory mechanism is a very big step. There are still a lot of questions about whether this is really going to be effective. There is some political undermining of the implementation, but it's there, and it's going to come into force. The fiscal backstop is there. It's going to come in later than originally planned, but that is probably also a good thing, because it will also allow some countries to prepare to opt in into this arrangement, even if you're not part of the Eurozone today. The resolution is absent, but it has been fast-tracked, and it's going to be very, very difficult, as Niels Thygesen said, and there's a possibility that this will in the end end up in a national framework, but clearly this is the most important element, in my view at least, of the banking union, and we need to find a solution that supports the single supervisory mechanism. Of course, and in the end we also want the deposit insurance, but that's even more remote at the moment. So the final aspect is the fiscal and political union. I think here, this is the new frontier. This is the issue that we are going to face over the next few years. We have seen a lot of ex-post mutualization of legacy debt. There is, as I said, ex-ante mutualization in the banking union. We're going to have this discussion. Can we live with a minimal fiscal union, or do we need something more? That's going to be the debate. And the political union, which is of course very closely tied to the fiscal union, that is of course even more remote at the moment. But we should note what I mentioned about the legitimacy of the banking union, but also the role of the European Parliament over the last year has increased quite substantially. Of course, that is in many ways, at least formally, a very the most legitimate element of the European institutions. So let me end with a comment on Cyprus. It's been referred to, and it is important. It's of course primarily a legacy issue. This is something that grew as a sort of time bomb inside the European the Eurozone for many years. But it's now also a signal, perhaps, of steady state. It's on the one hand, the final deal that was struck is protecting taxpayers, is protecting small depositors, it's bailing in large depositors and creditors. There are many issues here, of course. We can come back to in the discussion. It has this idea of a good bank, bad bank, to just restructure the banking system. It for the first time introduces capital controls with all that this potentially implies for financial integration in the Eurozone and European Union. And it certainly accelerates deleveraging, and it's going to make the next few years very difficult in Cyprus, and we will see a large output decline. But many people have said that Cyprus proves that the banking union is not feasible. In my view, this is actually a proof that we very much need a banking union, and we need to avoid repetition of Cyprus. Next up is Slovenia. Slovenia is very different. I won't go into it, but it's a much smaller banking sector, much smaller debt, but it still is a very vulnerable country. Going back to those original goals for a solution, we have to some extent managed to restore faith in the euro area. In terms of unemployment, clearly this is continuing to increase. It's a lagging variable, but there's no sense, I think, in the countries, particularly in the southern periphery, that we have seen the end of the growth in unemployment. There is maybe some signs that the slowdown in growth in the Eurozone is coming. It's coming to an end, but that's very uncertain. The debt levels, the private sector has been deleveraging, but the public sector, of course, has very significant debt levels. And we have made a big leap forward with the banking union, but there's a lot left to do. Finally, let me leave you with this picture. It's the Mario Draghi announcing the new €5 note, and with no irony missed, this is at the Archaeological Museum in Frankfurt. So, thank you very much.
Thank you very much, Erik, and apologies for delaying your presentation with these technical problems. We have to stick to 10 minutes for the coming presenters. I'm sorry, but we're bound to finish the session by about 12:45. So could I ask first Lars Feld, who will be the next speaker. Lars Feld is Professor of Economics at Freiburg University and director of the Eucken Institute, and he's also a member of the German Council of Economic Experts, which produced the debt redemption proposal.
So I don't have PowerPoint slides with me. I thought it's better to say what I would like to say in 10 minutes using old technology, so my own words simply. I'd like to make 5 comments, but I should say, or 5 remarks, but I should say the last one is integrated in the other 4 in each of those, which is the perspectives we are looking at. As Niels Thygesen said in his presentation, and also what Erik Berglöf has already underlined in his presentation, is the fact that last year at this time, and also in May and June, when the report of the Eurozone, of the INET Council on the Eurozone crisis was drafted, we had a lot of concern regarding the future of the euro. We feared that it's going to break apart, and of course we were not the only ones that feared that, but everybody feared it. And so there was a clear adjustment in interest rates, which was mainly due to an implicit depreciation premium in interest rates, and this could be well traced in most of those, in most of the government bonds under question. This concern about a situation when it comes to the perspectives is much reduced currently. So we are not fearing anymore that the Eurozone is not going to survive, or is not going to survive in the same, with the same number of countries. This concern was reduced mainly due to the action of the European Central Bank. It was the Draghi announcement that led to a stabilization of the Eurozone last year, but also stabilization regarding financial markets in general. We were well aware that the only institution that could provide quick relief in such a situation as we were last year was the European Central Bank. Any other proposals that were on the table, be it a long-term permanent mutualization or creating a banking union, resolving all the legacy debt issues in regarding public debt or private debt, all these things would have required much more action by heads of state and by governments in the European Union, and it would have required changes of the treaties as well. And as we know, this usually takes a lot of time. So the only institution that could bring relief was the ECB. But to some extent, at least regarding the compromise that we could come up in this group of 17 people, we were thinking that the ECB should not provide a permanent solution for the Eurozone crisis, and that more is needed than ECB action only. So, to make that clear again, in the short term, nothing else than the European Central Bank could provide relief. But there should be a transition towards other solutions, a fiscal solution on the one side and the banking union on the other side that should resolve the problems of the Eurozone. Regarding the ECB action, we cannot say at the moment that anyone in the European Union and the Eurozone member countries is actually thinking of a clear strategy of leaving the ECB out of responsibility in the current situation. So there's no clear sign that this is only a temporary relief that is provided by the ECB. It could well be that the heads of state leave the ECB alone in coping with Eurozone problems. The third point is, and there was much debate in the group about this, what should be the longer-term perspectives regarding fiscal union and regarding banking union. We were quick in coming up with a compromise suggestion for banking union. So it was not so much contested that a banking union is necessary. First, regarding supervisory authority, it was clear that there should be a European Union supervisory authority. We were a bit, we were relatively quiet about the fact where it should be assigned to, whether it should be the ECB or independent authorities, so we could not reach a compromise or consensus on that. But that a supervisory authority should exist in the European Union was clear for us all. The question whether it should be allocated at the ECB or outside of the ECB is also a question whether you are separating the supervisory function of the banking union and the resolution function of the banking union. Whenever the resolution authority is added, there must be a full democratic and legal control of resolution actions at the EU level, which is in fact somehow endangering the independence of the ECB if the ECB should have a supervisory and resolution authority. So this could not be in the same hands. And there are several problems emerging from the resolution authority when it is added to the ECB. The German Council of Economic Experts has decided in its last report to propose that the banking union should create it in a way that supervisory and resolution authority are in the same hands, and that this should be provided by an independent authority outside of the ECB. Of course, political decisions have been made differently up to now, but we have not finally come up with a clear decision on the resolution authority yet. And at some point this must be decided. What we are also having consensus on was the fiscal backstop, that it should be provided in the first place by the European Stability Mechanism, but further outlines of this fiscal backstop were also not decided in the group, and they must be decided in the longer term for the banking union. Regarding a fully fledged fiscal union, we had many different opinions in the group. The minimum consensus was that probably a full fiscal union with permanent mutualization of government debt is not necessary, at least. Some of us thought it is not useful to have something like that. When you want to have a fiscal union beyond the fiscal compact, it must be ensured that there is sufficient democratic control of fiscal actions at the European Union level. And on the other side, it must be ensured that the EU has credible control mechanisms. There must be a possibility to actually implement the EU mandates in a fiscal union, which is very difficult to achieve. I'm not aware of any federation which has established such credible interference mechanisms from the federal level to the sub-federal levels. And as long as this is not established, such a fiscal union cannot become credible. My final point is the transition from the crisis situation towards a transition towards the long-term perspective that we developed, according to the European Debt Redemption Pact, as the German Council of Economic Experts calls it. It's not only a temporary and limited mutualization of government debt of those countries which are not program countries and have government debt that is exceeding 60% of GDP, but there is also a part where governments must provide collateral securities safeguards that that is accompanying the mutualization on the other side. And this is somehow the position of the German government, saying, of course we are willing and also able to accept further stronger role in solving the legacy debt problems. But on the other side, we then must have further safeguards that are securing us from being exploited from the others. So this transition with the European Debt Redemption Pact needs a compromise from both sides, not only those who get the solidarity due to mutualization, but also from the other side. So what is the perspective overall? Well, we should not leave monetary policy alone in solving the crisis. And up to this point, regarding banking union, fiscal union, this transition scheme that I've briefly outlined, not much has been done yet. So legacy problems are not really addressed. Despite the fact that we are not so much concerned anymore about the existence of the Eurozone, about the existence of the Euro in the future, we should take the brief reactions after the Italian elections as well as the Cyprus case as an indicator that we are still not in a situation to say the problems have been resolved. There is perhaps a stronger or more severe surprise coming up this year when the German Constitutional Court is deciding on, well, in its final decision on the constitutionality of the current monetary policy in Europe, mainly the OMT program. If it really adopts a jurisdiction in that respect and does not leave it to the ECJ only, it might well be that it's going to be termed unconstitutional, and then we're going to see a surprise that it's really affecting the European Union more strongly than anything else that could come up this year. Thank you very much for the attention.
Thank you very much to Lars Feld for this view, even with a gloomy end note on the German Constitutional Court, which we had temporarily forgotten. The third speaker now is Professor Dennis Snower, President of the Institute of World Economics at Kiel and Professor at Christian Albrechts University in Kiel.
I had a presentation and obviously do not dare to request it. I correctly predicted that Erik and Lars would say everything useful that was to be said on the subjects that the chairman of this session outlined, leaving me free to discuss other matters. And the matters I'd like to discuss are what is the minimum set of proposals that would be necessary to clear up the Eurozone crisis. As a matter of personal judgment, but obviously drawing heavily on the INET Eurozone wisdom. I believe if we can summarize the outlook of the last two speakers without pre-verification, one could say that none of the problems in the Eurozone have been solved. We have monetary policy that is not sustainable. We have unemployment that continues to be unacceptably high and rising in some parts of Europe. The future of banking in Europe is open, and how to stimulate growth in Europe is wide open as well. Under those circumstances, what would be the minimum package that would be required to clean up this mess? And I think that the minimum package would require 3 different sets of policy measures. The first is fiscal, the second is monetary, and the third is structural. Let me deal with the fiscal first. There are visions for Europe: fiscal union, closer political union, and to my mind, these are desirable visions of the longer-term future. Are they achievable in the short run? No, I don't think so, because European identity is simply not strong enough to allow permanent fiscal transfers that voters throughout the European Union accept with unanimity or equanimity, simply because we're all Europeans. I think that is simply not in the cards. So given that that's not in the cards, and given that there is deficit bias in a lot of European countries, that the national debt is out of control in a number of European countries, we've got large problems of moral hazard, what is out there to deal with the fiscal problem? I believe that the most moderate proposal is to allow each country of the Eurozone the option of deciding its own fiscal rule, but to constrain what these fiscal rules would be. Each fiscal rule would have answer 3 questions. The first question is, what is the long-term ratio of debt to GDP? And fortunately, that's been answered by the Stability and Growth Pact. It mustn't exceed 60%. So every fiscal rule would mean that in the long run, the ratio of debt to GDP would have to be maximally 60%. The second question is, what is the speed of convergence to this long-run rate? All countries are above it. How quickly do we converge to it? And that is something that each country for itself would have to decide. And the third question is, how counter-cyclical should fiscal policy be? That means, in times of recession, how much can fiscal policy do to stimulate an economy in order to avoid falling into the Keynesian trap, where you're already in a recession, governments are forced to save, and in the process of saving, taxes collapse and transfer payments rise, and therefore the debt problem gets worse. How do you avoid that? How can you stimulate an economy in times of recession? Now, it goes without saying that if you have a long-term objective of bringing your debt to GDP ratio down to 60%, and if you're going to stimulate an economy in a recession, then you obviously have to do the opposite when the economy is booming. You don't really know when the next boom will come, but you most certainly know that it will have to be more than countervailing in order to reach your long-term objective. Now, if you allowed each country of the Eurozone the possibility of deciding for itself what its fiscal rule is, that is, how quickly to converge to the long-term debt to GDP ratio, and how countercyclical fiscal policy could be, then you would have fiscal responsibility, that is, financial markets would be assured that the problem of exploding debts was over, but you would have some fiscal autonomy. But the fiscal autonomy would be of a different sort. You would not allow countries the option of deciding government spending and taxes on a year-by-year basis, but instead countries would decide on a longer-term rule. And that would give voters new opportunities of thinking about how much debt to transfer to future generations, and it would give the democratic process much more traction than the current process that simply implies deficit bias without voter participation would imply. So that's the fiscal part. What's the minimum monetary part that would be required? Well, drawing heavily on the INET group, a banking union is categorically imperative. Common rules of regulation, supervision, and resolution in banking in Europe are absolutely necessary. Given that capital is mobile, you need this type of banking union. In addition, however, we've got a problem, and that is that we've got the problem of too big to fail. If you've got large, systemically relevant institutions that cannot be allowed to fail, these institutions, by their very nature, have inappropriate incentives. They'll generate too much risk because they can pocket the proceeds when times are good, and they can socialize the losses when times are bad. That generates excessive risks. How do you avoid this? To my mind, the simplest way of avoiding this is requiring all systemically relevant financial institutions to make all their debt, with the exception of deposits, convertible into equity if their capital ratio falls beneath a certain level. That is, if these banks threaten to become insolvent, then their debt automatically converts into equity, contingent convertible bonds, but mandatory contingent convertible bonds. What happens under those circumstances is that excessive debt, bankruptcy, is no longer a problem because the debt automatically converts into equity when there are problems of solvency. What also happens is that the stockholders in these institutions have an incentive to avoid excessive risk, because they will know that as soon as excessive risk has been produced, there is a danger that their stock will be diluted when this debt converts into equity. And that provides a natural incentive for these institutions to avoid excessive systemic risk. Now, I know the devil is in the detail, that there are problems if you don't specify the rules of the conversion appropriately. There are problems of a death spiral in case of severe banking crises. These problems are all possible to avoid. There's one transition problem, and that is that countries that are in a big crisis now may require further support. And there to have an interest equalization fund may help these countries out. And that is a redistribution that I believe the creditor countries could contemplate. Now, we've got a fiscal package, a monetary package, and then there is a structural package. How do you stimulate growth? Countries that have a persistent balance of payments deficit should be given support centrally by the European Union to stimulate their growth in terms of human capital, most certainly, and in terms of physical capital under certain conditions. And lots can be done in terms of using European structural funds, European Bank, European Investment Bank, to support this much more than has been done so far. This combination of fiscal proposal, monetary proposal, and structural proposal would put the debtor and creditor countries at ease. See, currently you've got a divergence of interest between creditor and debtor countries. The creditor countries want to know that the current problem will never recur again. You need a sustainable regime. And the debtor countries need support in times of crisis. And what you need currently is to provide both. You need to provide the support and at the same time provide a package that makes the European Union sustainable in the long run. And that meets the interests of both debtor and creditor countries simultaneously. At present, we've had piecemeal proposals that sometimes satisfy the creditors and sometimes satisfy the debtors, and it doesn't come together. The difficulty is to come out with a package, a holistic package that satisfies both debtors and creditors. And the minimal package that I outlined, in my opinion, would do the trick. If you do not believe that this minimal package has a chance of being implemented, then I think we ought to conclude that the future of the European Union may be bleak. Thank you.
Thank you very much, Dennis. Next speaker is Harold James, professor of history at Princeton. He's also the official historian of the background to the European Union in the sense that he published last year, Making Monetary Union Europe. Harold James.
Thank you. So far, we've listened to some rather sober and I think actually rather gloomy presentations, and I'm afraid I don't think that I can do much to lighten the mood or to cheer people up at this pre-lunch session. The question that Niels Thygesen asked us to think about, I think, is the right one. What have we done in terms of short-term solutions to the problem of the euro and of the European Union, and what have we done in terms of long-term solutions? The mood now is somewhat better than it was a year ago because the short-term solution has been clearer, and the main contribution to that is unambiguously the July the 26th speech last year, or the comments at the end of that speech by Mario Draghi, the do whatever it takes to solve the European crisis and to make sure that there's no risk perceived by the markets of the breakup of the European monetary union. But this puts all the emphasis on the ECB, and the ECB has become the only player that's really effective in terms of doing things on the European stage. And the result of that is that the ECB, like other central banks, is moving into a whole area of territory that's really unfamiliar to it. It's not any longer just doing monetary policy, but it's also doing a sort of fiscal policy. And it does that in terms of discussions about conditionality, but that puts an enormous degree of political strain. And we can see the likely outcome of this, I think, if you think of the discussion that will inevitably occur over the next months, whether Italy can or cannot form a government, and whether forming a government is the requirement for making a program that allows Italy potentially to draw on the OMT. So this is an issue that is likely to blow up and hasn't been solved. The ECB and its management is acutely aware of this problem. Both Jean-Claude Trichet and Mario Draghi have pointed out again and again that you just can't rely on the ECB as the only anti-crisis measure, but that it requires something else. Jean-Claude Trichet, when he was accepting the Charlemagne Prize in Aachen, said that in a long-term historical perspective, Europe is called to complete the design of what it already calls a union. And Draghi is much more explicit than that. He talks of four things, four pillars: a financial union, a fiscal union, an economic union, and a political union where the exercise of shared sovereignty is rooted in political legitimacy. But the problem with this, as the previous speakers pointed out, is that it's just unlikely to happen. It's really very, very unlikely to happen. And the mood in European countries, among European electorates, is swinging against this type of solution. And so in some ways, it seems to me that today the situation is actually gloomier than it was a year ago, because a year ago there was the doubt about the immediate survivability, but there was also a kind of confidence that in the end democracy would produce adequate solutions. That's challenged in the case of Italy. A year ago, you didn't have the question of geopolitics and security issues that is very radically raised by the aftermath of the Cyprus rescue, and the question, is Cyprus going to orient itself towards the EU, or is it going to orient itself towards Russia and look to a different kind of future? And above all, the discussion was less polarized in terms of disparities of wealth and income across European countries. One of the things that I thought was potentially explosive over the last months, last weeks indeed, hasn't really been raised yet, which is the Bundesbank survey that showed that wealth and income levels per household were lower in Germany than in the South European peripheral countries that were likely to become problems. And this really raises an enormously explosive issue. Now, whether the measurement is right or not, there's a discussion about this, because the household size in Germany is smaller than it is in Italy or Spain, so there's a difference there. That bigger families produce larger household income. There's the question of social security entitlements. But the raw facts of it are producing a really radical divergence in Europe, where people in the northern countries are saying, and this was a discussion that had already erupted in Slovakia very, very explicitly last year, people in the rescuer countries are saying, we're actually poorer than the people in the countries being rescued. Why should we do this? And once Europe starts to think of itself in these terms, it's absolutely hopeless and impossible to get any kind of solution. If we think of the solutions that were sketched out as part of the long-term package, that is some set of fiscal rules, a banking union, the very, very sensible proposals that Dennis Snow was just talking about. In a sense, it's again hard to be optimistic about this, because looking back, there was something like this that was discussed and almost created in the early 1990s. I mean, in fact, in some ways, this was the background to Maastricht, that there was a discussion of fiscal rules, and there was the confidence that the convergence criteria, the 3% deficit, the 60% debt criteria good as convergence criteria. But there was also, in the lead up to Maastricht, in the original version of the statutes of the ECB, really amazingly, a very, very extensive program for banking supervision and regulation. And in the aftermath of that is the little paragraph that appeared, which allows the European Council, if it does it unanimously, to delegate supervisory powers to the ECB. That's crucial in terms of the implementation of the current situation, but it was actually the remnant, the vestige of something that was much more generous and much more far-reaching, and was never realized. The fact that it wasn't realized then makes one wonder whether it's that easy to realize it now. And there's the same kind of process of formulating a big and ambitious and actually sensible long-term strategy and then chipping away at it when it comes to the implementation of these measures. I think the discussion of moving towards a fiscal union is very, very heavily motivated by discussions of whether the United States of America are a kind of precedent or a model for a future European state, for a United States of Europe, and whether the kind of mutualization of legacy debt that we're thinking about is has an equivalent in historical terms in 1790. This is the parallel that's made by Tom Sargent, but by many people, I think, as well, that what Alexander Hamilton did for the United States was crucial and built the foundations of the United States. But I think some things need to be recognized about the timing of this. First of all, that 1790, the mutualization of the debt, came after the US Constitution, after 1787. And so it was clear that you needed the political rules, the basic political rules, before you could get the mutualization. And that is the issue that's really still at stake. That's the issue that's raised by the treaty discussion. Secondly, the form of the mutualization, it required a distinct revenue stream that would feed the amortization, the servicing of the legacy debt of the states that was assumed in 1790. But this can be quite a source of tension, can be quite explosive if it's done in a wrong way. And in fact, the solution that was taken in 1790, the feeding of the mutualization of the debt, the payment of the mutualization of the debt, through the revenue of an external tariff, of a customs tariff, was deeply divisive in the United States, and it was perceived rightly as favoring the North, which was protected by the tariff against British and European competition, particularly against British competition, but being bad for the South that was dependent on imported southern goods. And the tariff fed through a series of conflicts that escalated in the 19th century and in the end produced civil war. So even mutualizing the debt doesn't do it. And so is there any other way round? I think if you think about this story, the only way of getting out of the European crisis really depends on building in additional elements of flexibility that you don't have in the original setup. Some of those are coming about as a result of the crisis. For instance, is it possible to think of a monetary policy that is differentiated in different countries, that has different collateral requirements in different countries, so as to replace the one-size-fits-all picture of the past? That's coming in after the crisis. But you might think that you need to be more radical than this. Would it be possible to have parallel currencies in an extreme situation? In a sense, this is something that is coming about in the aftermath of the discussion of Cyprus, because in some ways Cyprus has already exited from the European Monetary Union, in the sense that a euro in a Cyprus bank is not the same as a euro in a German bank. But more generally, I wonder whether we don't need to think of something that builds transfers across Europe without those transfers going through the mechanisms of states, because that's something where the American parallel is very, very important. If we had transfers that went automatically from one state to another state, if New Jersey had to pay for a problem in California or in Texas, this would produce as much disruption and as much social division as these kind of discussions produce in Europe. The way that the United States works is through automatic transfers through the fiscal system and through the social security system. But these are then entitlements of individuals rather than entitlements of states for transfers from other states. If I wanted to add something to the broad menu of issues that are on the table for discussion, it's exactly this. Shouldn't we really think of transfers through a social security system as a long-term way of dealing with European problems, rather than transfers between states which are bound to produce the political explosion and the political division that we see around us at the moment, and that are a possible solvent or an explosive of harmony and solidarity in Europe. And thank you.
Thank you very much, Harold, and thank you for not giving us the most bleak part of the paper that you were put on the net about the interwar conflicts nationally and between countries, reminding us of what that led to at that time. Leif Pagrotsky will be our last speaker. Leif is, as I said, the former minister in the Swedish government and a parliamentarian and of course an economist as well.
Thank you very much. Now it's only me between you and lunch, and we're already on overtime. Well, what can be done to fix this system? That was the short question that was posed in the invitation to this panel. What can we do to fix the problem? And we got 10 minutes to do it. I think we were worth a few more minutes of overdraft than that we have used now. One focus for Eurozone policymakers right now is the area of regulation and supervision of financial markets and macroeconomic surveillance. We have dealt a lot with that already today. The important question now is, will it do the job? Will this activity do the job? Can it be expected to make the system avoid future crises? And my test is a simple question. Would these measures that are now being developed, would these measures have saved us from the present crisis if it had been in place before? That's what I'll try to discuss in my remaining 8 minutes. As I see it, there are two different mechanics behind the present crisis. The first one is the one that's associated with names like Ireland and Spain, booms and bubbles, and the other one with countries like Greece and Italy that has to do with mismanagement of budgets and competitiveness and other things. So let's use Ireland as an example of the first group. Being a member of the monetary union, that means, of course, one interest rate for all and no national monetary policy. That's the starting point. And for Ireland, that meant a sudden adjustment to German interest rates while maintaining Irish growth rates, Irish inflation rates, and Irish catch-up phase in the economy. And that meant, of course, negative real rates of interest, exploding demand for credit, higher inflation, and even lower real rates of interest in a kind of, I wouldn't call it death spiral, but some kind of spiral into outer space, away from reality. I believe this mechanism made a bubble inevitable. It could not have been avoided. And of course, I do also believe then that supervision and surveillance would not have made a difference. because everybody could see it when it happened. It was not a secret. The credit expansion was numerically precisely described every month. And there was no reaction in spite of this knowledge. And even if there had been an awareness that this was not sustainable, there were no instruments available to stop it. So I don't believe it would have made a difference. And I used Ireland as an obvious example, but I think the same can be applied for Spain and Portugal as well. What about the other one, the other case, the one that I can illustrate with the name Greece? The background to the Greek problem was a long period of mismanagement, continuously eroding competitiveness since joining the euro, and a permanent big deficit and high public debt. Both these factors were there for all to see, no secrets, with the exception of the scandalous election year 2009, when the budget numbers were actually hidden by obvious cheating. As late as October, official records said 4% of GDP in deficit, whereas the actual numbers were 15% of GDP, when 10 months of the year had already passed. That year was an obvious cheat, but the rest of it was clear for everybody to see, more or less. There was something to do with the debt numbers, but it didn't change the overall picture. So, would today's or tomorrow's macroeconomic surveillance have helped in the case of Greece? I don't think so in this case either, because, as I said, it was already there for everybody to see, and it was accepted, nobody reacted. There were some phrases here and there in the annual reviews from the EU, IMF and the OECD, but not very much was done. So my conclusion is, it was not a lack of statistics or knowledge, but a failure on the part of everybody involved to realize what was underway. And there were, mind you, there were surveillance in place. Annual reports by OECD, IMF, and the EU Commission, numerous reports by independent banks and others, and they all showed the same pictures. I've gone through all the banks' reports from 2009, and they praised the Greek economy for having been able to avoid the downfall, the decline in GDP following the subprime phase of the American crisis. So it was the quality of the analysis and the political reactions that were the problems, not a lack of information or a lack of surveillance. I believe one fundamental problem behind this lack of understanding was, and still is, the intellectual attitude in the Eurozone. To avoid focus on anything that can raise doubts about the success of the Euro as a dream project, as a vision, as a dream. It was not allowed to disturb the image of the Euro as a great success. Another problem is the atmosphere and the culture among member states. Let's assume that they actually did find problems to do something about. There is a culture, and I can assure you, after attending dozens and dozens and dozens of council meetings, that there is a mechanism, an atmosphere saying, if I criticize you, I'll risk being criticized next time when you reverse the tables. And there is no risk to take, there is no reason to take such risk unless there are very important national interests at stake. You can do it in a budget negotiation over agricultural subsidies. But you don't do it over something as vague as, is a remote government doing a good job or not? And my conclusion is, peer review doesn't work. Just imagine as an experiment. Can you imagine Greece, Italy, Spain and Ireland voting against Finland or Netherlands or Germany or France? I can't. And therefore I don't believe that the democratically elected politicians can be in charge of this system. And I don't like non-democratically appointed people to do it either. It's a fundamental problem I have in devising a solution here. These problems could be avoided if surveillance was done by independent outsiders. I have no glasses, I'm sorry. These problems could be avoided by if somebody like the IMF or the OECD could take this role. But I don't believe in that either the way it is now. Things must change. The most important actor here could be the IMF. But as long as the managing director of the IMF is appointed by the Eurozone finance ministers, that cannot happen. That must change first. And I have not seen any such tendencies inside the Eurozone to realize that this is a problem and that this must change. So far, the Eurozone has appointed 3 people since the Euro was introduced. They were all finance ministers of the Euro countries. They were all part of the dream and part of the problem. And the present one was appointed in spite of the fact that she, in charge of 5 budgets, never ever proposed one budget that was in conformity with the Eurozone rules. She is now the credible police of the system. I think these are fundamental problems. And the OECD is a bit different. It's not subject to, it's not the Eurozone that appoints the OECD Secretary General. But you cannot become a Secretary General of the OECD if the Eurozone countries vote against you. So you must demonstrate a sympathetic attitude to the Euro and the Eurozone policies if you want that attractive job. So the mechanism is more or less similar there. The BIS may be something along the same lines. So my conclusion, the reforms on the way are welcome and they will improve the working of the Euro, but only to some limited extent. They will not prevent future bubbles, and I don't think they can prevent fiscal mismanagement either. But there is a risk that these reforms, although welcome, they will produce a feeling of problems being addressed, while the real problems remain. It's extremely difficult and extremely slow and extremely costly to improve competitiveness inside a monetary union. And it's impossible to repair fiscal imbalances between deficit and surplus countries with measures aimed only at deficit countries alone. These are, I believe, the real fundamental problems that may remain unaddressed if policymakers feel that they are addressing the core problems through these reforms we are discussing. So I'm afraid that my conclusion is pessimistic. I'm sorry, Mr. Thygesen. You asked for more optimistic tones. This will take a long time. It will not wreck the Euro or the EU, as was posed in the question to us, but it will wreck or perhaps even be a disaster for the European dream of our harmonious Europe, where we come together and share prosperity like a big family. And it will accelerate what the INET conference is all about. It will accelerate the change of guard in the global economy. Thank you.
Thank you very much also to Leif Pagrotsky. You will pardon me that I will not take questions from the floor. Unfortunately, I apologize for this delay, but we're losing the audience in the meantime. Let me just say in conclusion, thanking the panel, I think we had a number of good suggestions, both on the short-term measures, on the long-term program. Of course, both have to be addressed. I did not mean to separate the two in that sense. Both have to advance, and we had a number of useful ideas. Also reminding that two of our speakers were from the main creditor country, where these ideas are not all that popular still. But progress is being made, and I think maybe the last tone on which Leif Pagrotsky left us was too negative in the sense that it almost belied that we can learn from experience in economic policy making. In addition to the better analytical surveillance and more instruments that are now available, there's of course also the lesson that the alternative to following good policies is very unattractive. The notion of a bail-in, which is still used too uncritically, I think, about Europe, is not really relevant. Whether you're punished by markets more temporarily, or whether you go into a program with the IMF and others, it's a painful experience that no government would readily face up to. So that gives me some hope that the response to policy advice would be more positive in the future. Thank you very much indeed for your patience and apologies.